Right now, while you're watching this, we are living through one of the strangest moments in stock market history. One company that sells computer chips for artificial intelligence just reported the best quarter any chip company has ever had, around $57 billion of revenue in 3 months. Most of that came from one business line, data centers, and even the next quarter is guided to be even bigger. And what did the market do? Instead of cheering, the stock dropped. So here's the uncomfortable question I want to put in your mind today. What if the very company that built the AI gold rush is also the company that could break your portfolio? What if NVIDIA, the hero of this story, is no longer the one saving the market, but the one showing us how fragile this whole thing really is? That is the conflict we are going to walk through together. On one side, you have the dream. Artificial intelligence will change the world. It will make new medicine, smarter tools, faster code, better games, and new companies. On the other side, you have the math, prices, earnings, debt, and risk. And the math is starting to send warning signs that are very hard to ignore. Let me explain this in simple language, step by step. Over the last 2 years, NVIDIA has been like the strongest kid in the class who keeps lifting the average for everyone else. When you hear that the big stock index, the SP 500, hit new highs, it was often because a small group of tech giants, the so-called Magnificent Seven, moved up together. Inside that group, NVIDIA was the biggest engine. A huge part of the gains in the index came from AI-related stocks, not from the whole market rising in a healthy way. Recently, NVIDIA reported that huge quarter, about $57 billion in revenue. The data center part alone, which is where the AI chips live, brought in around $51 billion. That line grew more than 60% over the last year. The company also told investors it expects around $65 billion in revenue next quarter. Those are giant numbers. At first glance, everything looks perfect. But at the same time, a Bank of America survey of professional fund managers showed something new. 45% of them now say that an AI bubble is the biggest risk to the market. Just 1 month earlier, only about a third of them said that, so we have this strange mix. Record earnings and record fear. A hero stock putting up amazing numbers and professionals quietly saying, this looks like a bubble. To understand why, you have to leave the story side for a moment and look at the math. When NVIDIA stock was near its peak, the whole company was worth around $3 trillion on the market. That is more than the yearly output of entire countries. At that price level, NVIDIA was trading at many times its yearly revenue, much higher than what investors usually pay, even for amazing companies. Think about it like this. Imagine you run a lemonade stand. It makes $100 of sales in a summer. Someone comes to you and says, I want to buy your stand. If they pay $100, they are paying 1 time sales. If they pay $800, that is 8 times sales. That might make sense if your stand will grow fast. Now imagine someone offers you $1,300 for that same lemonade stand. That is 13 times sales. At that price, the buyer is saying, I believe you will have perfect summers every year for a very long time. No rain, no bad weeks, no other lemonade stands moving in. That is close to what the market did with NVIDIA. At peak prices, investors were paying a price that only made sense if everything went right for many years in a row. Very high growth, very high profits, no serious competition, no big mistakes. Even now, after the pullback, NVIDIA is still priced for almost perfect execution. In simple words, the stock price already assumes a lot of future success. When that happens, even great news can be treated as only good news. And sometimes good news is treated as not enough. You saw that after the latest earnings. NVIDIA beat expectations. It guided higher. It showed giant demand for AI chips. And yet the stock went down and pulled the rest of the market with it. That is a sign that we moved from the easy part of the story to the hard part. The part where expectations are so high that reality has trouble keeping up. To see the full picture, you also need to zoom out to the whole market. The overall SP 500 price to earnings ratio is close to 30. That means investors are paying around $30 for each dollar of earnings. When you smooth earnings over 10 years using the Shiller method, the ratio is even higher. It is near levels we saw around the dot-com bubble. At the same time, most of the gains in the index over the last 2 years came from a very small group of companies, the Magnificent Seven. If you take them out and look at an equal weighted index where each stock counts the same, the market looks much weaker. It is like a classroom where the average grade looks good because 7 students keep getting top marks while most of the class is barely passing. The average number looks fine. The reality behind it is fragile. Now add one more layer. Those same tech giants are spending insane amounts of money on AI infrastructure. New chips, new data centers, new networks. We are talking about hundreds of billions of dollars per year. Across the industry, AI-related spending is heading toward trillions over a few years. Here's the key. That spending has to make money back. It is not enough to build shiny data centers. Those data centers have to host products and services that real customers pay for. So far, a lot of AI use cases are still early or experimental. Models are powerful, but most companies are still figuring out how to turn them into stable, high-margin business lines. For example, one of the leading AI labs has a very high valuation, but still loses billions of dollars a year. Some of the cloud providers that rent AI capacity are signing huge deals that look amazing in press releases, but when you look inside, the deals are barely profitable or even loss-making in the short term. That brings us to what I call the AI circle of money. Let me make this very simple. Imagine a phone maker gives loans to customers so they can buy the phone. The customers take the loan, buy the phone, and the company books the sale as revenue. On paper, sales look great. Phones are flying off the shelves. But where did the money really come from? It came from the company itself. We are seeing a version of this in AI. NVIDIA invests in major AI players. These AI companies then sign giant contracts to buy NVIDIA chips. Microsoft invests in AI labs, buys lots of NVIDIA chips for its own cloud, and also puts money into another company that rents out NVIDIA-based computing to the same labs. NVIDIA in turn takes equity stakes in some of those partners. Money goes from chip makers to AI labs, from AI labs back to chip makers, from cloud giants to both sides. Revenue looks huge, but a lot of that demand is created inside a small closed circle of companies funding each other. People in finance have a dry name for this: vendor financing. Michael Burry, the investor who is famous in The Big Short Story, has warned that true end demand may be much smaller than it looks because so many customers are funded by their suppliers. Vendor financing is not illegal. It is not always bad. It can help build new infrastructure. But when it grows too big, it can hide the real size of the market. It makes it hard to tell where genuine customer demand ends and circular money flows begin. We saw this before in the dot-com era. Some tech companies would lend money to clients so they could buy routers or servers, then count those sales as normal revenue. As long as the loans kept flowing, the numbers looked great. When the financing stopped, demand suddenly vanished. Now link this back to NVIDIA and the market. If a large part of NVIDIA recent growth depends on a small circle of giant customers who are themselves under pressure to prove that AI spending creates profit, then the whole system depends on confidence. As long as everyone believes that AI will pay off soon, budgets stay huge. As long as budgets stay huge, NVIDIA numbers look amazing. As long as NVIDIA numbers look amazing, investors feel safe owning AI stocks and broad indexes that depend on them. But what happens if a few things change at the same time? Maybe one cloud giant looks at the numbers and says, "We are not getting enough profit from this AI capacity. We need to slow down our capital spending." Maybe regulators start asking harder questions about AI risks and energy use. Maybe interest rates stay higher than people hoped, and investors demand real earnings, not just stories. Maybe a big AI lab starts talking openly about how hard it is to turn powerful models into profitable products at scale. Then the circle starts to wobble. If big customers cut their AI budgets, NVIDIA future growth forecasts move down. If NVIDIA growth slows, its very high valuation becomes harder to defend. If the stock falls fast, index funds, hedge funds, and retail investors who leaned heavily into AI feel pain. They cut exposure somewhere to reduce risk. That selling can hit other tech names and then spread to the broader market. That is how a hero stock can turn into a pressure point. Remember, in the November Bank of America survey, almost half of fund managers called AI the biggest market risk. Many of them also said stocks in general look overvalued. So the first conflict we started with, can NVIDIA save this market, already has an answer. No single company can hold up a multi-trillion-dollar market forever. Not NVIDIA, not Microsoft, not Apple, not any other name. At some point the weight becomes too heavy. Now we arrive at the second conflict, which is the one that probably matters more to you personally. If AI might be a bubble, but AI is also the future. What do you actually do with your money? If you stay in the market, you are worried about a crash. If you leave the market, you are worried about missing out on more gains. If you own broad index funds, you are more exposed to AI than you think. If you try to pick safer stocks, you might still be buying companies that quietly depend on AI hype. So how do you navigate this without needing a PhD in finance? Let me give you a way to think about it in simple terms. First, separate the technology from the price. Artificial intelligence is real. It is powerful. It will be built into almost every product over time. In the long run, it will help create new industries and probably raise productivity, just like the internet did. But a good technology does not always mean a good investment at any price. If you buy something too expensive, even if it is amazing, your returns can be poor for many years. That happened in the dot-com boom. People were right that the internet would change everything, but many internet stocks still went down 90% when the bubble popped because they were priced as if the future had already arrived. So your first mental rule is simple. Love the technology, but question the price. Second, understand where your risk really sits. If you own an index fund that tracks the S&P 500, it sounds diversified. 500 companies feels like a lot, but because that index is weighted by market size, the biggest companies dominate your returns. When the Magnificent Seven do well, your fund looks great. When they struggle, your fund struggles. If NVIDIA or other AI names fall hard, your index is not a safe island. It is tied to the same storm. This does not mean index funds are bad. They are still one of the simplest tools for long-term investors. It just means you need to be honest about the hidden concentration. You are not as spread out as the marketing brochures make it sound. Third, remember that growth gets harder as numbers get bigger. Growing revenue 60% a year from a small base is one thing. Doing the same when you already make tens of billions per quarter is another. To add $1.8 trillion of value in a year, NVIDIA would have to keep doing the impossible over and over again, every year. That kind of straight-line growth almost never happens in real life. In my time at Microsoft, we had years where growth looked unstoppable. People believed the good times would last forever. But even then, growth slowed. Competition appeared. New technologies shifted attention elsewhere. There is always a next cycle. So when you see analysts draw lines up and to the right forever, remember that trees do not grow to the sky. Fourth, pay attention to incentives. Why are companies spending so much on AI right now? Part of it is real belief. Part of it is genuine need. AI can speed up coding, customer support, research, and more. But part of it is fear. Fear of being left behind. Fear of missing out on the next big platform shift. Executives know that investors want to hear the word AI on earnings calls. They know that big AI announcements can push stock prices higher, at least for a while. So there is a strong incentive to keep the AI spending story going, even when the business case is not fully clear. When you see everyone in a room running in the same direction, it is worth asking whether they are chasing an opportunity or running from the fear of looking slow. Fifth, focus on what you can control. You cannot control NVIDIA earnings. You cannot control how much Meta or Alphabet spend on data centers. You cannot control whether OpenAI or any other lab figures out a perfect business model next year or in 10 years. But you can control how much concentration risk you take. You can control whether you buy into hype at peak prices. You can control your time horizon and your need for short-term cash. If your goal is to grow wealth over decades, you do not need to predict the exact month when a bubble pops. You just need to avoid being the person who buys the most expensive story at the worst possible time. So how do we bring this together in a simple plan? Here's how I would think about it if I were starting fresh today. Step 1, know what you own. Sit down and look at your portfolio. If you own funds, search for their top holdings. If AI-related stocks like NVIDIA, Microsoft, Apple, Meta, Alphabet, Amazon, and Tesla are more than half of your total exposure, you are tied heavily to one story. That can work very well on the way up, but it cuts deeply on the way down. Being aware is the first step. Many people do not even realize that they are effectively making one giant bet on AI without ever choosing it directly. Step 2. Decide how much of your money is allowed to be in hot stories. Maybe that number is 10%. Maybe it is 20%. The exact number is personal. The key is to set a limit while you are calm, not in the middle of panic or euphoria. If your exposure to AI-related names is far above that limit, you can slowly rebalance over time. Not all at once, not based on news panic, but with a steady plan. That might mean adding more to other sectors or global funds instead of putting every new dollar into the same tech giants. Step 3, build a core that is boring on purpose. The most powerful thing you can do as an investor is not chasing the hottest stock. It is letting compounding work for a long time. That means holding a base of investments that are well diversified across sectors and regions with reasonable fees and not touching them every week. This core should be built for decades, not for the next quarter. It should be able to handle a world where AI wins fast, a world where AI wins slowly, and a world where some AI leaders today are replaced by new players tomorrow. Step 4, treat AI and NVIDIA as satellites, not the sun. You can still own them. You can still bet on the future. But do not build your entire galaxy around one company. If NVIDIA does well for 10 more years, you will still benefit through your holdings. If it stumbles, your life plans will not implode. That mental shift from hero worship to realistic position sizing is one of the most important moves you can make. Step 5, remember that cash flow matters more than stories. In the long run, stock prices follow earnings and cash flow. Stories attract attention. Numbers keep businesses alive. When you hear about yet another AI startup raising billions with no clear path to profit, be careful. When you hear that a cloud company signed a huge AI deal that looks exciting but will lose money for years, be careful. Ask one simple question. If the hype ended tomorrow, would this business still stand on its own? If the honest answer is no, it means a lot of current revenue might depend on circular money flows and market mood, not on real customer demand. Now let us come back to you sitting there, maybe holding an index fund on your phone, maybe owning a bit of NVIDIA directly, maybe feeling both excited and scared. The first conflict we started with was about the market. Can NVIDIA keep saving the market? We have seen that the math and the history say no. No single company can hold up an entire index forever. When expectations, valuations, and circular financing all stack up, the system becomes fragile, not strong. The second conflict is about you. Can you both benefit from AI and protect yourself from an AI bubble at the same time? The answer is yes, but it requires something very boring. Patience, discipline, and clear thinking. It means accepting that you will never hit the exact top or bottom. It means being fine with missing the last part of a rally if that last part is built on crazy valuations. It means being more interested in where your wealth will be in 10 or 20 years than in how your AI stocks will trade next week. Over 7 decades of market history, again and again, the same pattern shows up. The crowd falls in love with the story. Prices shoot far ahead of reality. Smart people start to worry early and get laughed at. Then one day, suddenly, the mood shifts. The pin finds the bubble. In the end, the basic rules of math and human behavior win. Right now, we are in a chapter where AI is both real and hyped. NVIDIA is both a fantastic business and a possible point of failure for a market that leaned on it too hard. You do not need to run away from technology. You do not need to sell everything and hide in cash. But you also do not need to buy into the idea that current prices will look cheap in every future. Your job is simpler and harder at the same time. Understand what you own. Question the stories. Respect the math. Protect your downside. Be willing to look stupid for a while by being careful while others chase the last part of a bubble. The market may keep rising for some time. Speculation often lasts longer than logic suggests. NVIDIA may even have more amazing quarters ahead, but gravity always shows up. It showed up for housing in 2008. It showed up for dot-coms in 2000. It showed up for the Nifty 50 in the 1970s. When gravity arrives for AI, you will not care who was right on social media. You will care whether you still own your future. So if you take one thing from this talk, let it be this. Do not confuse a great company with a perfect investment at any price. Do not let one stock or one story decide your entire fate. AI will change the world. NVIDIA is a big part of that. But your goal is not to worship the hero of this cycle. Your goal is to build a life where you can benefit from the future without betting everything on one roll of the dice. If you can keep that in mind, then when this AI chapter is old news and the market has moved on to its next obsession, you will still be here, calm, invested, and in control of your own story.